What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. What if I told you that crude oil could be heading to 90, S&P 500 probably continues to rally into the end of the year, maybe a blow off top at the end of this year or early next year. Fed keeps raising rates because we continue to get inflation. Then we have a recession in 2024, and the Fed starts to cut rates. Well, all of this and more in my interview today with Darius Dale from 42 Macro. Darius shares his background in finance and macroeconomics and how he overcame a significant challenge in his career. He also discusses the key market trends that he is currently tracking and how he manages risk in his portfolios. Darius also shares his top picks for the best investment opportunities in the current environment and his outlook for the market in the coming months. Today's podcast is sponsored by FTSE Russell and TradeStation. FTSE Russell is the home of the Russell 2000 Index. Did you know that with an 81% share and 1.6 trillion in institutional assets benchmark, the Russell 2000 is the top choice by far among institutional investors. Like all Russell US indexes, it's rules-based, transparent, and reliable, regularly updated with the latest IPOs and annually rebalanced. For more information, go to FTSERussell.com. Now, traders, if you're a serious futures trader like me and you want a powerful platform to match your skills, enjoy flexibility and trading power with TradeStation's award-winning platform. I've been using it for well over a decade. Now you can get 50% off brokerage fees for the lifetime of your account, plus 10% intraday margin rates on 3 popular futures when you open a new futures account at tradestation.com/Anthony. Before I get Darius in here, I want to remind all of you that the Futures Radio Show podcasts are recorded and posted on iTunes, Spotify, and really everywhere where you listen to your podcasts. D, welcome back to the show, my brother.
Anthony, what's up, man? It's good to see you again, man. I think you were my first podcast when we launched the business a little over 2 years ago. So I just want to say thanks for having me back, brother. Appreciate you.
Oh man, it's so great to see your success. I love your posts. You and I were talking prior to this. I love seeing you at Elf. I think it's always my must-watch macro when the two of you are together. You guys are fantastic. And
Appreciate
that
it.
recent one with Shapiro, man, Jason, that was awesome.
Folks needed to hear that one, man. I just got to say shout out to Jason Shapiro. I learned a lot in that video. If you folks haven't had a chance to check that out, it's on our YouTube page. It was a fantastic conversation, not about what's about to happen in markets, because I know that's what folks want from us talking heads in this business, but it was really about like how to become a better investor, how to become a better trader. And I'm sure we'll unpack a lot of that today.
Yeah, no doubt. For me, I watched that interview and I was like, this is something that no one's really done. And it was so important, like you said, to be said right now. And
Oh,
so
yeah.
everybody definitely go and check that out.
Thank you.
And today I want to start off with, I don't want to say a personal question, but look at all of us have had setbacks over the course of our careers. It goes without saying, and I talk about this all the time, but can you share a significant challenge or setback that you faced in your career and how did you overcome it?
Staying focused. So, folks who probably know my backstory, I've had to go through some pretty harsh stuff with respect to harassment and bullying online and whatnot with respect to that. And the best way I overcame it was to just do what I'm good at, which is focus on delivering value for our clients and helping our clients deliver alpha for their clients. And that's what God put me on this earth to do. And I'm very blessed to have the skill set to do that. And just being able to just say, hey, look, block out all the noise, focus on the things that I can control. And it's just been done wonders for me, for our business, for our clients. And I'm really grateful for that.
Yeah, man. I mean, I have so much respect for you because you stay the course, you're transparent, and I just love your whole approach to markets. And I love the way that you deliver the content because there's something to be said about that. Some people can't deliver it. And you actually have helped myself, and I've talked about this with you a lot in the past, understand the macro environment, even though that's not my lane, right? That I'm talking with you and you're up here and I'm way down at the bottom. And I try to learn from you and put that into action. And I think that the way that you do it is fantastic because it helps people like myself that want to get to that level incrementally get there. And you give us actionable stuff all the time. So I'm really looking
Thank you.
forward to what we have for you today. And now that we do have some little bit of a background on you, I've done a ton of podcasts with you. I know a lot of people are going to be watching this that have watched a lot of stuff that you and I have done in the past. Let's dive into some of these market trends that you're currently tracking. How do you see these market trends evolving in coming months? And what impact do you think they will have on the market?
Yeah, great question. I think in terms of how we see markets currently, the markets are currently pricing in what we call reflation at 42 macro. Reflation is a macroeconomic state whereby growth and inflation are accelerating on a trending basis. Now, that's obviously quite the opposite of what is happening from an economic standpoint. We have growth modestly slowing. We have obviously inflation slowing pretty sharply, particularly on a headline basis, not slowing as much on core. But that may be to be it may be the case that's about to start happening in the second half of the year, though we don't believe that is the case. There is a sort of incongruency with respect to what the economy is doing relative to what the asset markets are doing. And how we reconcile that incongruency is by understanding, having a real deep understanding of what's happening in the positioning cycle. This year, 2023, much like 2019, has been all about positioning and all about positioning relative to what the narrative was when those positions were put on and relative to how the data is unfolded from a surprise perspective throughout the process. Things like liquidity, things like the rate of change of growth, the rate of change of inflation, all this stuff is taking a back seat to the positioning cycle. And in our view, a couple of key narratives have really driven that. One, consensus was just dead wrong on the timing of recession in our view. We've been saying that since the fall of last year, that a recession was unlikely to materialize in the US economy until we got into Q4 of 2023 or Q1 of 2024. That is the modal outcome with respect to our business cycle timing models. And so we've been there all year, but what was not there and has obviously had to get dragged up in terms of the response in asset markets, particularly the S&P, Nasdaq type names, which is there was no recession. So this kind of record net short position or near record net short positioning amongst the buy side has obviously got taken out to the woodshed in the context of there not being an economic recession, nor was the earnings recession as bad as it was initially feared to be in the first half of the year. So that's one driver of the positioning cycle. The second driver of the positioning cycle is something that I think investors, I don't want to say they missed, but certainly it's been surprising even to us who got on board with this 6, 7 months ago, which is the pace of the immaculate disinflation. It's been very aggressive in terms of the type of disinflation we've observed prior to a recession commencing in the economy, which is very anomalous relative to history. We can touch on that later. And the pace of the disinflation has obviously supported real consumer incomes, which is something we called out last summer. And then as a function of that, it's delayed the recession relative to this very bearish investor consensus. But the reality is there was unlikely to ever be a recession in the first half of this year, according to our models. It's looking ahead. We do believe that there is likely to be a recession. It's probably going to be mild based on everything we know about historical recessions and what causes deeper than average recessions. We know that the Fed's reaction function to the recession is probably going to be delayed relative to previous recessions because one, their own guidance, but two, it's very unlikely that they see the kind of inflation outcomes that I think that they really want, which is 2% inflation. We've had a significant amount of American disinflation from 9 to let's call it 3, but the reality is going from 3 to 2 on headline, and more importantly, going from 4.5 to 2 core PCE type inflation measures. That's going to take quite some time. So in our view, the Fed's going to be late to the party, supplying liquidity. So that sort of sets us up for a blow off top into a market crash. Timing that's going to be very difficult, but obviously we have a bunch of tools in real time that we're going to help our clients, that we're going to freshen up our clients with in real time.
It's funny because you see that, and but yet we don't think that the Fed can see that. And look, in all seriousness, the Fed, should they be pausing or do they not see what you're seeing and they think that they have to continue to raise because of other reasons?
Yeah, so that's a great question. It really comes down to what is the neutral rate, right? I think in
Yeah.
this business cycle, we've had so many interesting, funky factors that have changed. I wouldn't say changed, not in a permanent way, but certainly have altered the neutral rate. I think if we all, we're all having a conversation in 2019 about the 5.5% Fed funds rate, we all would think the economy would be in some form of a deep depression. But the reality is the economy has proven to be quite resilient. So the reality is the neutral rate has gravitated higher, at least from a cyclical standpoint, and finding that neutral rate has been challenging for a Fed that's watching headline inflation dissipate, core inflation kind of stay sticky, growth hang in there. Obviously, the labor market's been booming for quite some time. And so they're getting a lot of mixed signals as it relates to where should they actually affect policy. But the reality is, if they want to achieve the kind of outcomes that they want from an inflation standpoint, they're probably going to have to take the economy into a recession. And the reason we say that is not because of poop and giggles. It's because that's the history of these business cycle processes. So I'll open up our macro scouting report. We publish this presentation on a monthly basis to 42 macro subscribers. But what I'm going to take you to this chart here where we show our Hope Plus I framework to give you a sense of how the business cycle typically works. So shout out to Mike Kantrowitz. I'm not sure if you're familiar with him over at Piper Sandler. He has what he calls his Hope framework, where he looks at these different cycles within the economy and how they have historically traded, or not traded, but how they have historically progressed in and around recession. And so, borrowing that kind of concept, we actually performed our own analysis and added inflation to the bunch, hence the Hope Plus I framework. And so, what we know from the basket of indicators that represents each of these cycles is probably about 8 to 10 indicators in each of these buckets representing those cycles in the economy. We know that housing tends to break down right around 18 months ahead of the business cycle or ahead of the recession. We know that orders tends to break down right around 8 to 10 months ahead of the recession. Production and profits tend to break down right around 4 to 6 months ahead of recession. Employment tends to break down right around the start of recession, which makes sense. Obviously, the NBER uses the employment data as a key anchor on the time in the business cycle. And then lastly, one important element here is that inflation tends to be the most lagging indicator of the business cycle. It tends to break down below trend, usually on balance 6 to 8 months after a recession begins. And so understanding that, we know that we still have a significant degree of core PCE, more structural levels of inflation. If you look at core PCE inflation, we're tracking at 4.6% on a year-over-year basis. We're tracking at 4.1% on a 3-month annualized basis. We haven't really gone anywhere in terms of the 3-month annualized growth rate in core PCE, really for almost 2 years now, for really 18 months now. Super core PCE is right around, we're going to get these numbers on Friday, by the way. It's going to go down, but it's probably going to still be at the same range that it's been in really since the fall of 2021. And so with that understanding, we have to take a step further and understand some of these kind of business cycle processes. And just looking at core PCE specifically, we know that in the year leading up to a recession, core PCE is typically flat, right around plus 5 basis points on a median basis in terms of the delta on year-over-year core PCE inflation. In fact, there's only one negative value in terms of core PCE inflation, which means only once in the history of that time series has core PCE decelerated into the start of a recession over the course of the year leading up to the recession. That's a long-winded way of saying all these different things, which is we've had a lot of really positive inflation outcomes. It's very likely that at some point in the second half of this year, the positivity is going to run out and we're going to be left with a structurally higher level of inflation relative to what the Fed has historically, relative to the Fed's 2% inflation target. And so ultimately, it's going to keep them on hold from a higher for longer standpoint when the recession finally does come, assuming it does come. Obviously, these are all probabilities we're talking here. There's no facts. There's nothing set in stone about the future.
I guess I go back to the Fed and raising rates in this environment. And I think about everything you're saying. And correct me if I'm wrong in this thinking, but they're going to continue to raise rates because they're not going to meet their inflation targets because
Mhm.
you think that it's going to get, you know, they're going to continue to fight it and it's not going to work out the way that they thought. And what you're saying is that you think that the market ultimately continues to learn to deal with it in some sense until at some point we have a blow off top. And then ultimately, the Fed is now in a position where the rates of inflation is now at or below their target and rates are too high. And then they're going to have to cut.
Yeah,
Is that the thinking?
Yeah, that's the story for next year. That's very much likely to be the outcome next year, whether it's a recession or not. If it's a
Got it.
recession, that just means inflation is going to come down harder, faster in that process. If there is no recession, let's say we do have a soft landing, then it's natural that over time we are going to start to still see decay in some of these inflation statistics just because of the lag with respect to owner's equivalent rent and the PCE housing inflation. The issue, if we do not have a recession, which is what we're arguing, is if we don't go through a recession, we're going through the terminal level of inflation will be considerably higher than the Fed's 2% target, perhaps even 3.5% on a core PCE type inflation based on all the analysis that we've historically done with respect to that time series and infusing today's momentum and changes until that forecast. And so if we have a soft landing, inflation is going to soft land as well. If we have a hard landing, inflation is going to hard land as well. But both roads lead to probable Fed rate cuts. One probably leads to something that looks more like 200 to 300 basis points of rate cuts, which is the hard landing next year, and obviously QE to supplement that. Then one probably just leads to maybe 50 to 100 basis points of rate cuts next year. What's priced into the market, if you look at OIS out to 2 years, so overnight index swaps, we're pricing in right around 200 basis points of Fed rate cuts between now and the end of the next 2 years. And so the markets are effectively betting on either a hard landing that causes the Fed to cut rates very aggressively, or the market is betting on a soft landing that just allows inflation to decay over a very long period of time and it allows the Fed to get to minus 200 basis points. So it's the same outcome, but the path is obviously very different from the perspective of a fixed income investor and likely from the perspective of an equity investor. And the reason I say this is because if we have a hard landing, it's very likely that asset markets have to price that in. We are very much of the view that we have not seen a recession priced in because, in our view, there has not been a recession to price in. There's been a recession in manufacturing, but manufacturing is only about 14% of total jobs and 18% of the total economy. And you can make the case that the manufacturing sector is already recovering if you look at the latest statistics in housing, citing that or some other leading indicators of the manufacturing sector, like the new orders and inventory spread. That stuff's on the rise. We believe that there was not a recession priced in. If we are correct that there is a recession likely on the come sometime in Q4 to Q1, when that process starts, not when you're going to see it obviously on the tape, but when that process starts is in Q4 or Q1, at least according to the modal outcome of our models. If that process does start and we do have a hard landing, the median drawdown in the S&P 500 in a recession is minus 24%, with an interquartile range of minus 19 to minus 39%. And so that process is ahead of us in our perspective. But between now and getting to the beginning of that process, we think there's a considerable amount of right tail risk for investors to have to either price in or get dragged into pricing in by the tape.
You couldn't have said it better, getting dragged into the pricing. How do these trends influence your investment strategy and decision making process right now?
They don't. That's the simple answer is we run a systematic portfolio construction approach for our clients. The process is designed to help investors compete with your 60/40 balanced fund by allocating 60/30/10 across fixed income and what we call macro asset classes for that final 10%, that the currencies, commodities, volatility on digital assets. And so that process is purely systematic. In terms of helping investors manage through this, the best way we help investors risk manage their own portfolios, it's two ways. We obviously have a bunch of discretionary tools that help investors generate trade ideas and whatnot, but that's not what I'm doing with my own money. What I'm doing with my own money is this. So this is our around the horn. We publish this on a weekly basis to our clients. That kind of just helps investors help us walk basically everything we think that they need to know on a weekly basis to manage risk in financial markets. The monthly presentation is everything we think they need to know from a longer term perspective to help think about their broader investment decision making across multiple, quarters, multiple years. And then from a weekly perspective is okay, what's happening along the way as we check the box or not check the box on some of those bigger themes. So going back to this 60/30/10 portfolio construction process I mentioned, what starts from a factor selection perspective, we use what we call our grid asset market back test to determine what the best, highest and lowest expected Sharpe ratios are by what we call our grid regime. And what we mean by grid regime is just what is the economy doing in rate of change terms. And so Goldilocks just means growth is accelerating and inflation is decelerating. Reflation just means growth and inflation are accelerating simultaneously. Inflation means that growth's decelerating and inflation's trending higher. And deflation just means both growth and inflation are slowing simultaneously. So that's a starting point. Okay, what's the economy doing in rate of change terms? How has the markets historically priced in those deltas, looking across different factor exposures in different asset markets, and then ultimately summarizing that so that we know what our shopping list is based on what regime we're in. And so right now we are currently in a deflation regime. I mentioned at the beginning, market is currently pricing in reflation, but we'll table that discussion because I have some different thoughts on that right now. But this is our shopping list. And so from a factor selection standpoint, we use what we call our 60/30/10 approach to help investors manage their beta exposure, but also understand which aspects of the fixed income and which aspects of the rest of the macro asset markets that they want to be in to outperform this anchor here, this 40 here. Because obviously last year, where everyone learned that was not the panacea of risk management that I think it was built out to be. And nor do I believe it's going to be the panacea of risk management that it's built out to be. We can talk about why I believe that separately. So that's the step one. So identify what factors we want to have for 60/30/10. The step two is we use our weather model to incorporate volatility targeting for the target exposures per the asset class. So let me introduce you to our weather model here. So our weather model, what we're doing here is we're actually scoring the what we call the 10 principal components of macro across the real economy and the financial economy in rate of change terms or extreme max min terms in order to identify the expected excess return dispersion on a forward-looking basis from each of these indicators. So each signal in each of these 20 indicators corresponds to sending some level of excess return dispersion to the stock market, to the bond market, to the dollar, to commodities and Bitcoin, so on and so forth, such that when you score it all up on an aggregated basis, we wind up with either a neutral signal for a particular asset class, which we currently have for the US dollar and the stock market. We wind up with a bullish signal for a particular asset class, which we currently have for the bond market, or we have a bearish signal for those asset classes or for other asset classes. And based on the signal that we're getting for the particular asset class, we'll use that signal to dial up or dial down our exposure to the particular asset class in the process. And for example, let's say we have 60, 30, 10. We're using SPY as a 60 currently. The SPY right now, because the weather model signal is bullish, or sorry, because the weather model signal is neutral, it's only 50% of its target allocation. It's as opposed to 60% of its target allocation. And for example, if we have one of those fixed income exposures of the 30-10, so it'd be three fixed income exposures as the target and then one macro exposure. Based on the weather model signal that we just highlighted for those particular asset classes, they could either be 10, 7.5, or 5%. So that's how we infuse volatility targeting, which is obviously stable modern day risk management, into the process. And then the last part of the process, systematic process, is we infuse dynamic position sizing into the process as well. And for example, let's go back to our friend the SPY. We know the target exposure for the SPY is 50% as opposed to 60% because the weather model signal is only neutral, it's not bullish. But the SPY is bullish from the perspective of how we track momentum in asset markets, which is through the lens of our volatility adjusted momentum signal. And so that's a two-factor model that scores volatility relative to price and uses volatility as a leading indicator for big inflection points in price. And so right now that signal is bullish for the SPY, so that the actual exposure equals 100% of the target exposure. So right now, the process is currently long 50% SPY as a function of the 60-30-10 approach, because again, it's neutral and it's got a bullish VAMP signal. Right now, the process is actually 0% long any of the fixed income exposures, because each of the fixed income exposures, though the weather model signal was actually bullish, calling for 10% target exposures apiece, they're actually all bearish from the perspective of our volatility adjusted momentum signal, and such they get 0% of their target exposure. So right now we're just collecting that 5.5% yield on those cash like instruments until the system tells us to get back long of those fixed income exposures. So that's a short-winded summary of how this process is designed to work. But I think that the two things that I think our investors really appreciate 42 Macro Research for is being very clear and cogent about these changes, these pivots. When these top-down risk management overlay pivots or these bottom-up risk management overlay pivots hit your inbox as a 42 Macro subscriber, it's coming from a place that there's a lot of quantitative systematic research behind why it's dialing up or dialing down its exposure to a particular asset class. Again, it could be either through a change in the weather model, or it could be a change in the volatility adjusted momentum signal for that particular asset class. There's a lot of work there, and that we can unpack any of those elements. This is how I manage my own money and how we help investors manage their money. There's obviously other ways in which we contribute to discretionary investment processes, but this is, in my opinion, I think this is a better mousetrap, generally speaking, certainly for retail investors and RA type investors.
Yeah, as a discretionary trader, I could tell you that there's so few people out there that should do that. I mean, just because I grew up in the industry as a discretionary trader, if I could go back, I would be only systematic. And I luckily built in some good habits that help me with discretionary trading. But I love your approach with the systematic model. And I want to talk about a couple things here. First off, when you say weather map, you're talking about your regimes, right?
Yes and no. So the weather model is different from the grid model. The grid model is, okay, what is the economy doing? What do I think the economy is going to do? The weather model is what you're seeing on this page here is what is actually happening. Don't tell me what you think the economy is going to do, Darius. What is actually happening? And
Got
there's
it.
a lot of forward-looking information in scoring what is actually happening in the economy. See, this is the dirty secret of finance, is that markets are forward-looking and they're perfectly and they price information perfectly, and there's all this. The markets are what's it called, efficient, and the reality is that's not the case at all. If you backtested this, I think as well as anyone, which is to understand that there's a lot of credible excess return dispersion that can be predicted by today's information. We've figured out a way to orchestrate backtest and set up models to do that. And this weather model is certainly one of those tools that we help investors do that with. This is the grid model. Again, what the economy is doing from a grid regime perspective, that's our starting point for factor selection. But the position sizing in itself comes from the weather model and it comes from our volatility adjusted momentum signal. So I agree with you, man. I think I'm a pretty smart guy who knows what he's doing in this business. And I am not capable of managing a discretionary trading process. Certainly not doing that and publishing research and marketing and doing client meetings and doing everything else that it takes to run a business. You need to, it's a full time job to be a discretionary trader if you're going to be making money and doing consistently making money at that. So the reality is you need to have guardrails. You need to have systems that have been proven to work with proven frameworks. And I think that's something we do very well here at 42 Macro.
Yeah, when it comes to my longer term account, very systematic in my approach. It's the day trading is where I use the discretion. With your information helps me with day trading. We're going to get to that in a little bit as well. I do want to discuss that. But what I first want to talk about is the regimes, the weather map. Let's talk about this risk management and how this works in a systematic approach. Can you discuss a time when your risk management strategies were put to the test? And how did your portfolio perform during
Yeah.
that time?
Yeah, no, totally. Actually, the most recent example was the beginning of June. So I've been tacitly bullish, but certainly not like raging. I think I turned into a raging bull after that signal. Like I've been bullish enough. We've certainly been managing a long only process and benefiting from the market, but it wasn't like I don't think I was out there leading the charge as the most bullish guy on global Wall Street. But the reality is, at the beginning of June, or at the end of May, or at the beginning of June, our weather model signal went bullish on equities, and it went bullish on equities specifically because the aggregated equities positioning, went to an extreme bearish positioning at the beginning of June. And so it ticked the weather model signal into a bullish state for the equities asset class and dialed up our exposure to equities and the max exposure to equities. So at the beginning of June, it went from 3% long its max exposure to equities to 100% long its max exposure to equities. And obviously our client base was, what the hell, man? No, I don't know if I feel like doing this. And I'm like, just trust the process, man. Just trust the signal. Another example of this is like even going back to, I want to say it was in May, late April or early May, the weather model signal went bearish on fixed income. And this is back at, I wouldn't say at the height of the regional banking issue, but certainly the regional banking issue was still residually part of the market narrative in terms of like potentially pulling forward Fed easing or pulling forward a recession, credit crunch, all that jazz. But the reality is the weather model signal said, no, this is a time to be selling bonds. And we saw like from basically like early May through mid June, bond yields, let's use the 10 year as an example, backed up like 50, 60 basis points. And so there's a couple of signals there where if you only anchored on the news flow and the narrative out there in global macro, you would have done the exact opposite of what those two signals told you to do. And so that's what I'm learning, certainly having been running this process for about 7 months now, which is just close your ears or, earmuffs. Signal says do it. It's not always going to be right, but it's going to be more right than your gut feeling and your gut reaction to whatever the news flow is of that day or that week or that month. And so it's certainly been helpful in that regard.
The market is full of potential investment opportunities, really, I think, at all times, right? It's just different market environments, but there's always potential investment opportunities. But it's always difficult to know which ones are the best. What are your top picks for the best investment opportunities in this current market environment?
Oh, my number one pick is invest in your own education, right? Like we can talk about the potential trades to put on in the market environment, but number one would be just figure out who you are as an investor and invest in supplementing that and covering your blind spots. Like supplement who you are as an investor. Make sure that you're only swinging at strikes. You're not swinging outside of the strike zone when it comes to the types of trades or the types of investments you're working on. And then making sure that you, at the bare minimum, have something in your process that is core to that is risk management only, right? Like you need to understand like where the pitches are, where the strikes are, what the balls are. But ultimately, at the end of the day, you also need to have this sort of risk management overlay that can really help you as an investor. So to me, the best thing you can be doing at any given time as an investor is working on yourself, working on your craft, helping yourself manage those behavioral kind of pitfalls that we all have as human beings through the prism of risk management. So that's number one. Number two, expect the blow off top in the U.S. equity market. One, it's historically consistent with in fact, consistent is not even an appropriate word to describe this. It happens every time. And the reason it happens every time, in my view, is probably because of the positioning cycle, right? The Fed's hiked interest rates. We know that there's going to be some long and variable lag with which the economy has an adverse reaction to 500 plus basis points of policy tightening and $95 billion a month of QT, although it hasn't really had much of an impact in recent months because it's not draining bank reserves. But the reality is, if you go back and you study market cycles, in and around these late business cycle kind of turning points. What we find is that the year leading up to the peak of the market, the S&P is up plus 16% on a median basis with an interquartile range of plus 11 to plus 20%. There are no non-double digit values in this 13 cycle sample. So let me so at the bare minimum, at the year leading up to the to a recession, to wherever the S&P peaks ahead of the recession, which is typically right around a month ahead of the trough in the unemployment rate or a month ahead of the breakout in jobless claims. It tends to be very coincident with the kind of big inflection in the labor market, or slightly leading right around what month ahead of that. The market is up 16%, interquartile range 11 to 20, no non-double digit values in that sample. So we always know the market squeezes investors leading into a recession. What we also found doing incremental research on this, and this is something we published, I want to say back in May, to help investors get on board with, hey, look, I know there's a lot of bears out here, but it's better to capitulate sooner rather than later. And what we find is that if you look at the last 3 months of the market cycle leading up to recession, actually more than half of that plus 16% median return comes in the last 3 months. It's that median return in the last 3 months is plus 9%. So let's play the clock forward. Our fundamental analysis tells us that a recession is likely to commence, likely to begin sometime in Q4 of this year or Q1 of next year. So, based on everything I just said, the stock market should peak sometime in Q4 of this year or Q1 of next year, based on when the inflection in the labor market really starts to come home and roost. The market tends to peak about a month ahead of that. If the market peaks sometime in Q4 of this year or Q1 of next year, that's about 4 to 6 months of additional right tail risk to have to price in. And we're starting from a 13th percentile investor positioning score in aggregated US equities, futures, and options positioning. Like, you put those two things together with a market that is historically squeezed into the final innings of the pre-recession bull market, and with a starting point of one of the deepest net short positions ever in the aggregated futures and options space in US equities. To me, it screams like very aggressive bull off top as the kind of modal outcome from that starting point, plus that starting point of positioning, plus the market history associated with these pre-recession bull market processes. So that's my modal outcome. If we don't have a bull off top, it's going to be more, in my opinion, going to be because of something that we literally can't forecast. It's going to be something that comes out of nowhere and causes the market to go down. But if nothing comes out of nowhere, investors need to be prepared for a bull off top, a serious bull off top.
And that really goes back to that Jason Shapiro interview that you guys talked about some of these things in there.
Yeah. Can I show you a chart?
Yeah, absolutely.
So there's a bunch of models that we publish daily in our lead off morning note and every week in our Around the Horn. Around the Horn comes with a webcast, so I'm explaining all the stuff. But obviously, if you're daily, you're probably a sophisticated investor or professional money manager, so you don't need me to go ahead and explain everything on a daily basis. But the reality is, everything you're seeing here from here is something that we publish on a daily basis. And so publish on a daily or 6 times a week. It's either Monday through Friday for the lead off morning note, and then every Saturday for the Around the Horn. But this aggregated cross asset positioning slide, in my opinion, is very instructive in helping investors understand like where we are in the positioning cycle. And so what I'm showing here in terms of the 4 asset classes that are shown here, I'm aggregating non-commercial net length as a percent of total open interest for all the different markets in those asset classes. And so for equities, I'm obviously taking Russell Dow, S&P, NASDAQ, rates, all the rates across the curve, dollar, all the major currencies, all the major commodities. And then I'm summing the total longs, subtracting the total shorts, and divided by the total amount of open interest, and then showing those time series on a percentile basis relative to the historical time series. And so right now, that aggregated non-commercial net length as a percent of total open interest for US equities is in the 13th percentile of data going all the way back to 1998. Like folks are dug in bearish from a positioning standpoint, right? They're actually more dug in bearish than they were at the October 22 lows. So that to me is, red flag. Why are people more net short today after a vicious, rally in the stock market relative to where they were at the October 22 lows? And to me, I think Jason Shapiro hit that point on his head in our discussion last week, which is folks are just dug into the narrative. They're dug in, and there's got to be a recession. It's got to happen today. It's got to, and then it's all got to get priced in so I can be around this positioning. But the reality is, this positioning is probably going to be right if our expectation is correct on a 6 to 9 month basis. But it's just getting to the 6 to 9 months, right? You still got like 3 to 4 months to get there, or 4 to 6 months to get there. That's the problem. And so when you sum it all up, and from a positioning standpoint, like it's just I don't understand how this doesn't get squeezed out of the market. To me, I really do see risk of a market that runs away from people in the back half of the year. That's not on anything fundamental aside from the recession just hasn't started yet, which is something we've been calling for since last fall.
I 100% agree with you on that. The one thing I will say about when you look at data like this is when you look at equities versus commodities, and I think we should talk a little bit about commodities as well before I let you go, is how much of this can we attest to just being short versus, especially when you're looking at futures and options on futures as potential hedges to a lot of long positions?
Yeah, no, that's a good question. We're looking at non-commercial, so it's only the speculators, right? And so I think when you're thinking about it's always only the speculators. The speculators, in my opinion, are the people who matter, right? These are the people who are
Yeah.
going to see information and changes their positioning. The person. There's really no. I don't think there is any commercials in stocks, but correct me if I'm wrong. But the reality is, it's the speculators are what's going to be driving the bus here from a positioning cycle standpoint, right? Like this positioning, maybe it doesn't capitulate, but in my opinion, just the mere fact that it starts from such a low level means that there is more buying pressure in the market than selling pressure. Think about the markets. The market is a
Yes.
residual of supply and demand, right? That's what the price of any asset is, or any good, service, or asset. It's this intersection of supply and demand. And so, what I'm effectively saying is, there's a lot of folks who need to buy the market because they haven't bought it, but there probably aren't many people who need to sell the market. And so you just think about this. If we roll forward in time and the CTAs have their hands on this thing and the quants have their hands on this thing, and even the fundamentalists who are now starting to look into 2024 and seeing a recovery in earnings, they start to get their hands on this thing. There's a community who dug in, kind of what I would consider to be probably macro oriented investors who are, very leaning heavily short here, and they're
Yeah.
not obeying the history of asset markets, the ever researchable history of asset markets, right? It didn't take too much for me to figure out those statistics I threw out at you in terms of the pre-recession bull markets that we've experienced. If you heard that from me in May and you were super bearish in May, you still could have made 10% in the S&P by just changing your positioning in May. But folks, for whatever reason, they're really dug into this bearish narrative. And I think being dug in the bearish narrative is part of the reason why so many folks, not being dug in the bearish narratives, being dug into macro narratives is part of the reason why so many folks struggle to consistently profit from asset markets. Because the reality is the market doesn't give a damn about any of our narratives. The market's going to price in what it's going to price in, and it's our job to take advantage of it. We run some pretty sophisticated models to help investors understand what the hell is the market pricing in. We call this our global macro risk matrix, where we're scoring 42 different markets on a daily basis through the lens of our volatility adjusted momentum signal. And then we're scoring that relative to how they have historically traded in those particular regimes. And then we tally this stuff all up. And so right now, when I said we are currently in a reflation regime, reflation is the dominant regime. It's a pretty middling conviction score, means it can go higher. We've seen reflation get to these levels in recent market cycles past, so it's not like something we need to be overly concerned about it, reversing. And we've done math on this. The probability of being in a reflation regime 3 months from now, when you tally up the kind of the three conditional factors that we're targeting, is somewhere around 66%. And so if I told you that we're currently in reflation, is obviously bullish for risk assets, bearish for bonds, kind of things of that nature. If we're in reflation and we have a 30 to 66% chance of being reflation 3 months from now, and you're sitting there as a bear, like what gives? Like to me, this is you just start with this as an investor and then backfill your narrative. And when you find inconsistencies and incongruencies that are actually giving you an appropriate price to chase that trade in the markets, like you see something that's a high conviction in your process, but is not currently being priced in, that's when you can go all in on a move. But right now, I think this ultra bearish positioning in U.S. equities, in my opinion, is not doing that. It's keeping with the same narratives from last year and just rolling them forward in time. And unfortunately, if a lot of folks have had to roll their hedges higher in price because the market is getting away from them.
How much of this do you think is the mindset, don't fade the Fed? We were in an environment where the Fed kept cutting rates and everyone just says, you just got to be long. Fed's cutting rates, you got to be long, right? All this liquidity out there, buy it. I was told, Darius, that when the Fed is raising rates the way that they are, you don't want to be long stocks. I think that is a big part of why even a lot of my friends that are they got a lot of money and they're big investors aren't really participating in this market.
Yeah, I think it's reasonable. And again, I think if you're a longer term investor and don't need to give a crap about 2023's return, right? Like
Yeah.
it's not a bull market to anybody who bought it in January 3rd, 2022. They don't think it's a bull market. So we're not in a real new bull market, right? Like you need to be concerned as an investor if we somehow go into a new bull market. Let's say our view on recession is wrong, right? Like our modal outcome is that we have a recession that starts in Q4 of this year or in Q1 of next year. We don't, the models that we use are 6 month intervals, not 3 month intervals. So that's the 6 month interval that has the highest probability of seeing a recession start. But what if that modal outcome is wrong? What if there's a soft landing in the economy? How do you what in a bear's process is going to allow them to say this is a soft landing, I need to get long? I don't know. And so this is why what I said earlier, you got to have risk management tools and systems that have nothing to do with your fundamental view to keep you in line along the way, right? We're currently in a reflation regime. If you believe in the ultra bear case, the S&P is going back to 3,000 or something like that, and you're just not going to participate in a reflation regime, that's fine. But how many months do we need to be in a reflation regime for you to say, okay, I need to change that view? Or at the bare minimum, I need to stop putting these positions on and wait till we get out of the reflation regime. Wait till the weather model signal on equities goes bearish. Wait till we get some other positioning data that says it's a better time to put this bear trade on. I'm not saying we have it all figured out in terms of our tools and systems, but I certainly think we're doing better than the mean investors, a lot better than the mean investor. I consult many of the top funds on Wall Street and have done for most of my career.
A couple of things before I let you go. Commodities.
Yeah.
Let's talk specifically oil.
Yep.
It's the one to watch. Oil is finally starting to support some of the bulls out there. For me, I actually have been trading in and out of oil to the long side in my account over the last couple of weeks. And I see this market from a technical and even a fundamental picture that oil is looking like it could have some legs on a rally here. What do you think about oil?
It's woken up, man. So let's take it back to the chart where we show our global macros matrix. That's crude oil there broke to bullish on our signal a couple of weeks ago. So like for the first time in months. And so I'm like, okay, what's going on here in oil? And you take it to the chart and you just I use our volatility adjustable momentum signal as our baseline for technical analysis. But just eyeballing the chart, it's man, this is a long-term consolidation. If we break out of this long-term consolidation, we got the bare minimum. We start retesting levels that so it's coincided with the prior breakdown. So you're talking about oil probably going back to 90 if this bullish move sustained. And what's going to sustain this bullish move, in our view, it's China. If you look over and you look at what the Chinese where they're targeting with respect to stimulus, they're guiding to some pretty not I don't want to say healthy fiscal expenditure numbers, but they're guiding to like numbers that are going to create better outcomes than what we've seen in the Chinese economy in the first half of the year. I think one of the calls that we made back in February was to liquidate all of our China and related holdings like base metals, et cetera. Not our, but investors to liquidate their China related holdings because we saw the potentiality for China to reopen in what we call a structural liquidity trap. Like in our view, China was in a structural liquidity trap prior to COVID. And so just reopening the economy with no real stimulus, you're just basically pushing them back on the street. But you lock up a homeless person, and then when they get out of jail, it's like, where do you think they're going? They're not going to move into the Ritz Carlton. They're probably going to be homeless again. And so this is China entering and exiting zero COVID. It is just, we can talk about that, some societal issues that we got going in this country, but that's neither here nor there for this discussion. And so it was our view that, hey, China's going to come back and be in this kind of weak economy in the absence of fiscal stimulus. And we didn't really get any material fiscal stimulus. And so it's looking now just as a function of all the economic disappointment we've seen in China. If you go back, you look at what to say with the economic surprise indices, China's economic surprises are among the most negative in the world right now. In fact, actually, no, Eurozone just beat them out here. But China, for a long time, had the biggest negative economic surprises in the world for a really long period of time. And clearly, the PBOC, the powers that be in Beijing, have really put their heads together on saying, what can we do to stimulate this economy that doesn't like aggressively ratchet up the debt overhang that we're currently dealing with from a structural liquidity trap perspective? This is why they're in a structural liquidity trap. So much of the incremental growth in that economy has to go to servicing debt rather than capitalizing new investment and capitalizing consumption. And so that's where China is. So in our view, I think we're going to see much more positive outcomes from certainly on a relative basis to expectations, which are now declined a decent amount from a growth rate perspective. So we're probably going to see more positive economic surprises on a trend basis as we progress throughout 2H23 in China. And we're also going to see, in our view, that be supported because of the incremental fiscal stimulus. I think they've learned their lesson on what it is that they actually needed to do to put this economy on its own 2 feet. So I'm expecting better economic outcomes out of China. I'm expecting better performance out of commodities markets. And you go back to these commodity markets, let's just look at these. We were bearish in base metals, and now we're neutral. We're neutral in agriculture. Now we're bullish. We've been bullish for a while. We're neutral in crude oil. We're now bullish for a while. We were neutral for a little bit in Bitcoin, but bullish, but that's not really a China story. But for a lot of these commodity like plays in our global macro risk matrix, they're starting to wake up. And in our opinion, they're starting to wake up on what could be very fundamental news if we go through forward the next 2, 3 months of Chinese data.
Yeah, that fits into what you've been discussing as inflation's going to stay hotter. And when you look at inflation, you're going to be looking at ags. You say you're bullish agriculture, you're bullish oil. And that ultimately is what's going to feed into this higher for longer in the Fed. And because we're seeing it happen right in front of us right now. And one thing you said you were neutral on is gold. And I'm just curious, where does gold fit in right now within your investment process?
So gold is actually bullish. Gold is bullish right now. Yeah. So
In
gold.
metals, I think you maybe said we're neutral.
Yeah,
Yep.
metals. The base metals are neutral. Base metals are
Yes.
neutral.
Yeah.
And so where gold, this is reflation is a decent environment for gold. It's not the best environment for gold because typically in reflation you have rising real interest rates. But right in this particular reflation regime, it seems like the move in real interest rates has already come and gone. Maybe we start to see another back to 4% on the 10 year. In fact, I wouldn't be surprised if we did see that. Because what I'm also expecting, if you look, roll the clock forward like 3 or 4 months from now, like right now, in our view, the immaculate disinflation narrative has really dominated Wall Street, and appropriately so. It's an unusual dynamic. We've almost never seen this amount of disinflation ahead of a recession. So it's called immaculate for a reason. It's our view based on the timing of recession being at least 4 to 6 months away in terms of starting that process. We're probably going to see inflation firm up in the second half of the year, likely relative to consensus expectations, but perhaps on an absolute basis as well. Like we might, like the disinflation that we're experiencing currently might, trend towards zero, and we start to get stuck at a higher level of inflation. And the reason we might get stuck at a higher level of inflation is because we continue to tax the economy from the perspective of pulling on the demand for labor. Or we're obviously not creating this. If you look at where productivity is trended throughout the pandemic, we're not creating enough goods and services to account for that tax on the demand for labor that we continue to contribute. So we are still, like, from a core inflation standpoint, building inflationary pressures because we are still in expansion, right? Eventually, we're going to run out of bodies to hire, and it's going to be companies going to have a decent amount of pricing power, and workers are going to have a decent amount of wage bargaining power. So I'm concerned that, if we're having this conversation 6 months from now, what would have materially changed? I'm concerned that by 6 months from now, by the end of this year, the narrative on inflation is likely to have materially changed. And the narrative on inflation will be right now, it's immaculate disinflation. Let's just hope for a soft landing. If it keeps going, we are going to have a soft landing because we don't need to over tighten. But I think by the end of the year, one of these things that could stop the blow off top process is the narrative on inflation shifting to we ain't going back to 2% without a recession. And I don't know when what I just said becomes consensus. I suspect by the end of the year, I don't have a crystal ball on that, but just in terms of our model and how we see the inflation data playing out over the next a couple of quarters, I do believe that the narrative will change and evolve into that. And that's obviously not a positive dynamic for the market, but it's positive for commodities though, because it'll increase investors' desire and willingness to speculate in those markets.
Last question for today. What is the greatest risk facing the market right now, and how is your portfolio, your systematic portfolio, positioned to mitigate that risk?
Oh no! So it's the greatest risk, in my opinion, facing the market right now is right tail risk to the upside. I think the biggest risk I see to the market, based on everything we do on a systematic perspective, based on everything we say from a qualitative perspective, and all the research that we do every month to support those qualitative views, to me, the biggest risk is the right tail risk. And because again, risk works in both directions. It's not just left tail risk that we have to be concerned about as investors. And then when I say this, I'm talking about specifically about institutional investors, buy siders, folks who are benchmarked against indices, folks who need to generate returns to stay in the seat that they're in, right? And have money to manage, right? To me, it's the right tail risk. It's the underinvestment and the underperformance of the buy side in 2023. Because really, all this stuff really only matters to the professional investors. If you're a retail investor, who gives a damn about if it's 2023 or not? Like, you don't need to be monitoring your returns annually like some sort of fund manager. But the reality is, if you are a fund manager, it's highly likely you're underperforming. It's highly likely you're still underinvested relative to your benchmark. And so to me, the risk is that the market really continues to run away from them and they have to chase. That to me is the biggest risk that I see out there in the marketplace. After that process concludes, in our view, then the biggest risk will be a recession that develops in the US and more than likely global economies. Because again, I don't think the US can go into recession and not drag Europe down with it, not drag parts of EM down with it. And so that will eventually become the biggest risk. But between now and then, I think the biggest risk is right tail risk. And you asked, how is our process? How is our systematic process helping investors or helping myself? Because I use that process to run my own money. How is it dealing with that? It's currently at 83% of its max exposure to equities. Right. It's 83 is a very high percentage relative to everything I said about recession in 4 to 6 months. But it's going to stay that way until there's some risk management signal, either through the weather model or either through our volatility adjusted momentum signal that says take that down from 83% of its max exposure. Hell, it might go up to 100% of its max exposure between now and then. Who knows? I don't know. I don't want to tell the process what to do. It's stochastic in that nature. But the reality is, I want to be taking advantage of that risk, that right tail risk, as opposed to fading it.
DD, this was fantastic. A lot to unfold for the rest of the year. Where can people go to learn more about you? Give us Twitter, give us your website.
Thank you, Anthony. I appreciate it. Always lovely having these conversations, man. You ask very humble questions. And you can only ask humble questions because you're done pretending to be cool. You're someone who's been around the block and you know what you're doing and you've seen it all before. So you can just ask the right question as opposed to trying to sound smart while you're asking the question. And I can tell when when being interviewed by somebody that there's a huge difference. And I appreciate what you're doing, man.
Thank you so much, buddy. I appreciate that a lot.
No, definitely, man. So I appreciate you for having me, man. Definitely come check us out. We're at 42macro.com. As I mentioned, like we consult many of the top asset managers on Wall Street. We also have high net worth retail subscribers, RAs, who consume our research as well. If you can't afford our research, which we think is reasonably priced, but if you can't afford it, you're not that place in your investment career yet, definitely check us out on Twitter. 42 Macro Weather is my Twitter account. Post stuff to LinkedIn too as well. I think Facebook as well. So you know where to come find us. We're on YouTube as well. So all the different channels, 42 Macro, just search that.
Yeah, and I always say you got to start by following some of the things he does on Twitter to understand it. And then the more you get in and dig deep on what D is doing and his team, then you're it because
Thank
you
you.
love it. And
Thank
so,
you.
all right, and I appreciate you so much, and I can't wait to have you back on.
Always a pleasure, man. Thank you so very much, man. And you guys, by the way, you guys are dealing with a good one here, man. I've learned so much from you over the years. So I just want to humbly say thank you for having me on because it means a lot, man. Thank you.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.